Hello, everyone, and welcome to our webinar. It's a pleasure to have you. Today, we're highlighting and discussing the prize-winning paper, Selling Fast and Buying Slow. And the authors of the paper are here to present and to take questions. This is, of course, the DFA prize, and I'm sure you know about DFA. If you don't, it's a well-known asset manager with deep ties with academic research, and they have been generous supporters of academic work, including this prize and other prizes. And they have been doing it for a number of years. And we have with us Jacobo Rodriguez, who is the head of research at the DFA, and he's going to say a few words before we take a deep dive into the work.
Well, good morning, everybody. Thank you, Leonid. And first, congratulations to the winners for writing a wonderful paper, which I had an opportunity to read again last night. And then also thank you very much to the Journal of Finance and the American Finance Association for giving us the opportunity to be associated with them and to contribute to the prize money for these prizes. It's an honor for us. As Leonid said, we have deep ties to the academic community, and our investment strategies are rooted in academia. And so it is a pleasure for us and an honor, as I said, to be able to contribute to the development of academic financial science. So with that, thank you, and I'm looking forward to the presentation.
Thank you, Jacobo. Before we get started, I just want to know that we have a Q&A running. And so please enter your questions. They're going to be answered either through the chat by the authors or at the end of our webinar. So please stay engaged. And now I'm going to give the mic to Larry, who is going to present the paper.
All right. Well, thank you so much for giving us the opportunity to talk about this paper. And thank you as well to DFA for your very generous award. We're really thrilled to present this and to get everyone's perspective on this. So the title of the paper is Selling Fast and Buying Slow, Heuristics and Trading Performance of Institutional Investors. This is joint work with Klakow, Rick, and Alex, who are all also here on the call, and they'll be available to answer questions as we go and also in Q&A after the talk. So our starting point in writing this paper is there's this very rich literature in finance and in economics which thinks about the importance of heuristics and biases in sort of driving wedges between how people actually make decisions in the real world and how they do in our economic models. And we've learned a lot from this literature, and often it challenges kind of standard workhorse normative models of how people make decisions. And I don't think it's a stretch to say that one of the most successful branches of this literature has been in behavioral finance. And I think one of the reasons for finance in particular is just because the stakes are always quite high. You know, when someone doesn't refinance their mortgage optimally, they're potentially leaving tens of thousands of dollars, if not more, on the table. And so what's fascinating about this literature as we dig into it is that there's a number of behavioral biases. And again, the thing that makes these financial contexts often quite special is that these are repeated and consequential decisions amongst investors. And so at this point, we've got lots of evidence. One of the earliest patterns we found was the so-called disposition effect. We've got lots of evidence about people being overconfident, kind of thinking about investment decisions as sort of gambling or, you know, ways of getting utility rather than actually kind of saving for the future. And there's another literature which we're going to make more direct contact with today, which thinks about the role of limited attention. And in addition, I would mention there's kind of another literature more on the asset pricing side, which kind of reflects information processing frictions. And so we've got lots of evidence at this point that there's a failure of asset prices to incorporate certain signals as effectively as they often do in our models. And so while this has been a very successful literature, I would say that there's also been a bit of pushback. And honestly, this was part of the reason why this paper started was, you know, I was maybe more in the rational camp before we started this project. And Alex and I have been, you know, friends, and we were classmates in grad schools. And we've been arguing for a long time about the extent to which these biases really matter for the smart money. You know, we've got a lot of this evidence comes from retail investors or day traders, to the extent where we have some of these really large administrative data sets, these are still, households who have lots of other things going on in their lives, and they often hold very modest portfolios, and we know that they on average lose money. And so, there's just mostly due to data limitations, there's a dearth of studies on so-called smart money in these asset markets. And this is a little different from corporate decisions, where we at least have some evidence on behavioral biases, the extent to which they affect CFOs and other decision makers. And so, we typically will often kind of write these behavioral models where it's the institutions who are the smart money, who are fully rational, and they're picking off these behavioral individual smaller investors who kind of collectively might own a lot of the market. And so there's this view that kind of expertise and lots of practice will kind of correct mispricing. And as I mentioned, kind of the inferences about this debate are kind of largely limited due to data limitations. And so in this paper, what we're going to do is we're going to exploit a really unique data set, which has information about the daily holdings and trades of market experts. These are kind of the biggest, most successful portfolio managers. These are the ones who are winning very large clients. They're quite positively selected. And in that sandbox, we're going to be able to study separately the performance of both buying and selling decisions. We're going to characterize kind of how people buy and how people sell. And importantly, we're going to document some evidence on the use of heuristics and where those heuristics apply. Finally, we're going to be able to, because we have lots of data across a variety of contexts, we're going to be able to quantify the potential costs of using these heuristics on performance. And if you want to kind of think about a very simple kind of summary of the research question and finding, it's, in most of the models we would write down, whether I add to a portfolio or I reduce, I eliminate some existing positions from a portfolio, those are really just two sides of the same coin. We typically write our models in such a way that the thing that matters is the optimal portfolio weight, and then I just do whatever transactions I need to do in order to achieve that. Are buying and selling decisions just two sides of the same coin? The evidence that I'm going to show you in this paper is a kind of resounding no. So let me kind of jump in and I'll tell you a little bit about our sample. So here we're going to be able to use a really cool and unique data set, which has information about the individual holdings and trades of a large number of institutional portfolio. How does this work? Well, basically, Rick, one of my co-authors, he runs a firm called Inalytics, and Inalytics acts as an informational intermediary between, say, pension funds, who might be a typical client of Inalytics, and their portfolio managers. And the goal is to kind of collect information in real time so that those clients can get more informative information about kind of how these PMs are behaving. So we're going to be able to see data which are mostly collected in real time for about 783 institutional portfolios covering the time period from 2003 to 2016. So who should we have in mind here? Think about, say, MIT's endowment, a large, big client like a pension fund. And that pension fund or endowment is going to hire a institutional asset manager for a separately managed account. Most of this data is collected in real time. And in contrast to all of these small retail investors who we know kind of collectively either earn the same as the market or often underperform, especially net of their transaction costs, the average portfolio in this sample is actually going to beat their client designated benchmark by about 2.5 percentage points per year. Importantly, these the managers that we're looking at in our sample, they're going to have a long only constraint, which is a typical constraint in this context. And so this does impose an important kind of reality on these asset managers, which is that if I have a cool new idea and I want to execute on that idea, I'm going to need to sell something that I already own in order to execute on that cool new idea. Okay, and so typically cash holdings are very small, so you're not going to be able to move into and out of a cash position, and you're not going to be holding, index funds or things like that as well. So that if I want an analogy to my life as an academic, I have a finite amount of time, and so if I want to work on an exciting new paper, which I love to do, I'm going to have to stop working on one of my existing projects. And I think that analogy to kind of the buying decision, which is the new projects, versus the selling decision, which is kind of finishing existing projects, is actually pretty close to when we think about a lot of the behavioral forces at play. Okay, so just some numbers. The total market value represented by our portfolios is $459 billion. The average market value of the portfolio, now this is just a single client, so keep in mind that these PMs that we're talking about might be running a similar strategy for lots of different clients, but just one customer alone is putting an average about $600 million on the table. These are diversified, but not fully diversified portfolios. So the typical average number of stocks will be something like 80. They're going to have long holding periods. So these stocks will be in the portfolios for about a year and a half on average. And remarkably, we're going to be able to observe 4.4 million individual trades in our sample. And we're going to have about 90 million kind of stock portfolio date observations in our sample. So it's going to be a really nice high frequency laboratory to study institutional investors. Now, we've been able to look a little bit at how these folks trade. Typically, that's been with the quarterly holdings data that you can get from, say, mutual fund filings or 13F. Here we have daily resolution. Now, why might buying and selling processes differ? So there's been proposals in the literature that when you think about buying and selling, there's just very different psychological processes in play. And since I'm a big fan of Matt Levine, let me just quote Matt, kind of how he thinks about this. He says, if you hang around the financial markets, you'll get all sorts of advice about how to decide which stocks to buy. And almost all of it comes down to some sort of fundamental analysis of the underlying businesses. But you will also get less, but some advice about how to decide which stocks to sell. And it will often be pretty heuristic. Cut your losses and let your winners run is a thing people say, which has nothing to do with the underlying businesses. If you double your money, sell and take profits, it says in Barron's. The basic folksy rule of thumb wisdom for buying is about fundamentals, but for selling is about price action. The basic folksy rule of thumb, sorry, I copied that twice. All right, so what's also fun about this is that Rick, in the course of doing business, is actually talking with the decision makers in our sample. And so these are some representative quotes from these conversations Rick has had with these asset managers. When I sell, I'm done with it. In fact, after I sell, I go through and delete the name of the position from the entire research universe. Selling is simply a cash raising exercise for the next buying idea. Buying is an investment decision. Selling is something else. And I don't think we should just pick on the PMs here, because if I think about, say, my own MBA teaching, my class is all about NPV. It's about investment decisions. And I would say that if I think about most of the projects that I have, they're always about something new. It's fun to think about adding that new factory. We don't spend nearly as much time thinking about how to divest the existing factory that might be a loser. And there's some interesting evidence that actually kind of divesting poorly is a source of losses at the firm level. Okay, so now what I want to do is use these data in order to get an estimate of kind of the potential benefits and costs of buying and selling well. So what are we going to do here? We're going to use a very simple counterfactual strategy in order to evaluate performance. So the idea is going to be, I'm going to fix a holding period. Think of H as that holding period is varying between, say, 1 month and 1 year. Those are the types of horizons that I'll show you. And I'm going to compare the realized return of the actual stock that I chose to trade, either to buy or to sell, with a feasible alternative strategy over that same period from T+1 to T+H. Now, if we're worried about, say, potential market microstructure type concerns, because again, these are very big fish, we're also going to do some things where we kind of delay the start of that window to allow for potential price impact to dissipate. That's not going to turn out to matter for our estimates at all. So the main counterfactual of interest that I'm going to have in mind is to say that instead of buying or selling the actual stock that I chose to trade, let me throw a dart at my holdings and randomly trade one of the other position that's already in the portfolio in the same direction. Okay, so you could think about this as a very mechanical alternative. And if people are thinking about what they're doing, they should be able to outperform this very simple strategy. Now, what does it mean to outperform? Well, I want to buy low and sell high. So ideally, if I'm buying something, it means that the asset that I choose to buy is going to have a higher return over that holding period than the counterfactual stock that I could have bought otherwise. What about selling? Well, you want to sell high. And so what would be a sign of a good sale would be if that stock subsequently does badly. So we're basically going to flip the sign. So here, selling well, adding value to the portfolio by eliminating things that would have dragged your performance downward, means that the counterfactual should do better than the stock that I sold. In other words, the losses on the stock that I sold should be larger than the losses on the stock that I could have sold otherwise. This strategy is always feasible on the margin, right? At least if we're thinking about kind of small reductions in the size. Now, I should mention that this approach is not the same as the standard measures, like if you think about benchmark adjusted returns or risk adjusted returns. And part of the challenge here is that you don't hold the benchmark. And in fact, these are portfolios that are going to beat their benchmarks on average. And so that would kind of mechanically potentially mean that counterfactual of just selling the benchmark instead isn't really a feasible strategy. So let's now turn to our first result. Is there skill in buying? So what I'm going to do is, again, we're going to fix the holding period H. Fix this holding period H, and then look at the realized returns over the next H periods. I'll show you a graph of the difference between the expected return on the stock that I actually bought versus a random stock bought from my existing holdings instead. Is there skill in buying? Yes. So in this graph, again, the x-axis tells us how long we've waited. So like a month, a quarter, half a year, 3 quarters, or 4 quarters. And we're going to look at the difference between the stock that I chose to buy relative to a counterfactual. Now, on the y-axis, notice that this says that it's the factor neutral return. So I am adjusting here for potential differences in exposures to Carhart factors when I do this. But I'm kind of doing that for both legs of the portfolio. So I'm going to do that for the stock that I buy and the stock that I could have bought instead. What do we see? At a 1-year horizon, each buy transaction, those stocks are outperforming existing holdings by about 116 basis points. It's about 83 basis points at a 6-month horizon, 34 bips at a 1-month horizon. Okay, so we have clear evidence that there is value added coming from these buy transactions. Okay, so now let's think about the other side. So if we, again, to stick with my academic analogy, the buying is really like coming up with a great idea for a new paper. Or if you're a manager, this could be coming up with a cool new product that you could launch to the market. But in order to get to make that thing real, I'm going to have to take some of my time, take it away from my existing projects in order to allocate it to that new project. And because these portfolio managers can't just use leverage in order to buy the new stock that they want to buy, or kind of risk considerations would mean that's impractical anyway, these portfolio managers are going to have to sell in order to buy. So again, it's going to be unfair to compare selling to a counterfactual of selling the benchmark because they don't hold the benchmark. And the typical stock they hold is actually going to outperform the benchmark in our sample period. So I'm going to compare to this very lazy, no skill strategy of randomly selling an alternative stock, something that they chose not to trade instead. By the way, we can also say exclude things that they're very recently bought and added to the portfolio. There's lots of different ways we've done this. The results are always quite similar. Do they do better than random sells? The answer is no. Okay, and so one of the major results of the paper is kind of summarized in this plot right here, which is, again, we're going to ask, how does this stock that I turned out to sell add or subtract from the value of the portfolio? So negative here basically means that the stock that I sold goes up by more than the stock that I could have sold instead. Okay, what are the magnitudes? It's almost like 2 steps forward, 1 step back, or even 3 steps forward, 2 steps back. At a 1-year horizon, the stocks that are sold are underperforming are outperforming the stocks that could have been sold instead by 80 basis points. That's 50 basis points at a 6-month horizon, 21 basis points at a 90-day horizon. So again, this is kind of our first major result, which says that it does not look like they are adding value to their portfolio. In fact, they are actively reducing value from their portfolio through their selling strategies. Okay, so something we do in the paper, this is in table 2, is we've asked, okay, these are kind of trade-based measures. How do these trade-based measures connect with kind of broader measures of how the portfolio is doing? And so what we show is that our measure of value added coming from buys has exactly the same predictive power for how the portfolio will do in terms of its average returns on our sample as the returns on these selling value added measure. So this says that in terms of portfolio performance, profits and losses enter in the same way. Both of these value added measures affect the performance of the portfolio in equal ways. So they are both equally costly. We also do a whole bunch of robustness checks. So we think about lots of different ways of adjusting for risk. For example, a concern that I had was maybe we were adjusting factor loadings or things like that. This actually speaks to a recent literature where we've thought about this so-called inelastic markets hypothesis, the idea that institutional investors don't time the markets very aggressively. And interestingly, we find very little evidence of the PMs in our sample, again, very large institutional portfolios they're managing, that they're timing the market very aggressively. We've also, you might worry about, price impact or things related to microcaps or illiquid stocks. We can throw those out. We've done lots of different ways of selecting a counterfactual. You can make sure that it has a similar portfolio weight in the portfolio or a similar idiosyncratic volatility if you think about, say, tracking error type concerns. And we've also focused on larger trades. Interestingly enough, the underperformance is larger for the big trades. You might have thought that I do, very poorly on very tiny trades that don't matter, but it's actually the opposite. We can also wait a week to rule out transitory price impacts. We've also done a little bit of sorting in our data, where we've basically classified portfolios into different categories based on characteristics. So what we find is that bad selling is most pronounced in portfolios that have high concentration, so kind of small numbers of holdings, high tracking error, and value tilts. Consistent with maybe an intuition that I might have that if I do kind of momentum type strategies, I'm used to buying and selling a lot, and that's an important component of the performance of that trade. We find that those funds which have a high exposure of their returns to the momentum factor, those managers are not as bad at selling as the others. So what could explain this discrepancy? That's going to be what we're going to look at for the rest of the paper. So our basic argument here is that managers are going to be using a heuristic process for selling and not buying. It's kind of consistent with the quotes that I gave you, which suggest that, selling isn't really seen as part of the job. It may not even be part of how you win clients by saying, oh, I had this really terrible stock in my portfolio. It's so good that I got rid of it. So the results that we're going to show are very consistent with an asymmetric allocation of cognitive resources. So one first question is just, well, maybe, selling is a strategy that's much more constrained. I can only, in a long only world, I can only benefit from selling if I sell one of the names in my portfolio. So maybe that's more difficult than buying, where I can search over all the different potential names in the universe. So what we're going to do to kind of ask whether they lack fundamental skill in selling is we're going to look at events which might plausibly lead portfolio managers to shift their attention towards monitoring very closely their existing holdings. So in particular, we're going to look at the buying and selling decisions that are made around earnings announcement days, because we know that this is a time when there's lots of information that's being revealed. There's usually lots of idiosyncratic volatility of stocks around this time. So it's kind of a good time to pay attention closely to the names that are already in your portfolio. So what are we going to find? This is a graph which is just going to show you how the portfolio does on buys and sells. Again, this is just a different version of what I already showed you. I added a year and a half just for fun. Okay, so this is no new information here. But then let me layer into this the sells. So again, I'm going to compute these value-added measures, sort of how you do relative to a random cell counterfactual. How do we do if we sell on an earnings announcement day? And strikingly, you don't see evidence of underperforming on sales. Now, I should mention there aren't nearly as many earnings announcement days in our sample as everything else, so standard errors are a little bit larger here. But what we can do is basically say, how do my buy trades around earnings announcements do relative to my buy trades on any other day? That's the left panel. Again, you can say that we can't reject the null hypothesis that basically I'm doing about the same on the buys that happen around earnings announcements versus the buys that happen on any other random day. The buy trades, in other words, look underperformed, they're beating their benchmarks, etc. What about the sell trades? Here, we can see that those differences that I showed you on the last slide are statistically significant. So again, when the manager has incentives or is much more likely to be paying attention, we see that the manager is doing a lot better with their sell trades. So next, what we want to do is actually kind of go under the hood, because one advantage here is that I can see the whole portfolio, not just the trades. And so I'm going to ask whether I can predict the buying or the selling decisions that these PMs in our sample make. So what are they selling? You know, we want to kind of think about why selling strategies might underperform here. So Barber and Odin emphasized kind of how decision makers might proceed in a world where they face information processing frictions. You kind of have limited attention, limited bandwidth you can allocate to a decision. Often what this literature has found is that people will first restrict attention from the full set of possible names to a smaller consideration set. When I shop on Amazon, I'm not going to go through all the different pages of results. I might just look at the first few hits, for example. So limited attention is going to constrain that consideration set. And then heuristics or biases might affect what we actually choose from within that set. Okay, and there's been a lot of evidence about kind of how these considerations are formed, but often we find that these consideration sets typically kind of overweight assets which are extreme in terms of salient attributes. And in the portfolio management context, what is the most salient attribute you can think of? Returns. What happened to the stock yesterday? What happened last week? Has it been winning or losing over the last quarter? You get signals about this stuff all the time. You can have text alerts sent to your phone. It's on your apps. It can keep you from sleeping at night. And so we're going to focus on a natural measure of salience in this context, which is prior returns. So how is this stock doing relative to all the other names in my portfolio or relative to my benchmark? We're going to build on some of our friend Sam Hartzmark's work here in looking at prior returns. So something that Sam showed in his job market paper, this is for individual investors, but there's also kind of consistent evidence for mutual fund managers as well, but at kind of a lower frequency, is if you look at individual investors, they're much, much more likely to sell either the stock that has done the absolute best or the absolute worst in their portfolio. This is the so-called rank effect. Okay, and he shows that this is costly. It's a drag on performance. So what we're going to do is kind of ask, are the managers in our sample using this heuristic? And you can also imagine that they might be using this heuristic in terms of thinking about which stocks they actually want to buy. So what we're going to do is take all the positions in our portfolio. You know, there's about 80 names in average. We're going to sort positions into 20 bins based on how they've done relative to the benchmark. And then I'm going to estimate daily models of the probability that you sell these different assets in your portfolio. And what's nice here is that I actually have a natural control group. What's the natural control group? Well, I showed you that they're really good at buying. So I can ask, how do you buy? Can I predict what you're going to buy? And I'd say that, you know, the one thing that I can predict that you're going to buy, like the best predictor is, did you buy this thing like a week ago? Okay. So what we're going to do is kind of exclude things that they, you know, really recently just started buying, because we typically think that's splitting up trades as you build up a position to minimize your price impact, etc. Let's look at the propensity to buy or sell based on your past return. Okay, and so I've got a graph here where as we move from left to right, we've got the stocks that have done the absolute worst to the absolute best in my portfolio. And this dashed vertical line is kind of where gains become losses. So if you go to the left of it, they're losses. If you go to the right of it, we're in the gain domain. What's the key punchline? Price action has almost no impact on how you buy. So, you know, when we look at these PMs, very consistent with the idea that you're looking at the value of the stock. In an efficient markets world, the signal coming from what happened to the stock this week or this quarter is kind of irrelevant. I want to know what it's worth in the long run. That looks consistent with how these managers buy. And remember, their buy trades work quite well. What about the sales? Let's now go to the right part of the graph where we look at the selling strategy. In sharp contrast to these buying decisions, which are very difficult for me to predict, we see this very pronounced U shape, very much in line with Sam's rank effect. Okay, so if you look at the stocks that have done the best or the worst, I think this is based on quarterly returns and what I'm going to show you here, you'll see that we're far more likely to sell these ones that have been extreme and therefore are salient in terms of recent returns. This is the same if you even just look at what happened over the last week, which you might think is an even crappier signal of what people should be doing in the long run. Okay, and so there's a bunch of explanations you might have in mind on the table, and we've tried to address many of them. It's got a long internet appendix, this paper. You might worry about taxes or concerns about reporting to clients. Maybe you want to kind of get this stuff out of the portfolio. These things, first, I should mention the tax thing is kind of off the table because almost all the portfolios we have are non-taxable. This is going to hold at many different horizons. It's not kind of special at quarter end, for example. You might worry about these stocks that tend to be extreme or have other characteristics. Maybe this is sort of risk management because they might be more volatile. We can match on lots of things, double sort on these variables. It's not going to change anything. And importantly, in our regressions, we're going to be able to include stock date fixed effects. So I'm comparing a manager who holds this stock where it's kind of in the far right tail in terms of relative performance with another manager who holds the same stock on the same day. And so we're going to kind of difference out any stock time varying unobservables when we do that. Maybe like new buys or large trades just tend look extreme. The result is basically the same. If we expand this consideration set, we see the same U shape even for the really big trades, the really large sells. We don't see any of this evidence for the large buys. We've kind of colloquially called them on our research team marriage and divorce. Just to kind of throw a little shade, because there's that expression that those who can't do, they teach, and I teach. The fact that I, using a simple status script, can predict your selling strategy based on a really simple observable is not a good signal of your skill. And consistent with that, the trades that outperform the buys, I can't predict what they're going to do at all, other than just saying, well, you bought it a week ago, so maybe you want to buy it again. So what are they actually choosing to sell? We dig under the hood a little more using these holdings. And what the data suggests is that it's the assets to which they're least attached. So if you kind of look at this consideration set that the managers have, one thing that we see as well is that in addition to these kind of recent return type signals, there are stocks that have a low active share. So what is the active share? That's the difference between the weight the portfolio manager puts on this security minus the weight in the benchmark. And if you have a low active share, it's kind of like you're gambling with a dollar, right? You're not really putting a lot of money on the table. These are kind of low conviction positions. I don't win a lot. I don't lose a lot if they outperform my benchmarks. What we see is that these low active share positions are about 140% more likely to be sold than an average position. Now, these low active shares can be present for two reasons. One is that, say, the stock is just big in the benchmark, and I'm worried about tracking error. So I want to hold a similar weight as the benchmark to kind of keep my tracking error in line. The other possibility is that it used to be a high active share position and it went down. But actually, the biggest reason why this happened is it's just a low conviction idea. It's like a side bet. It's a small bet. It's not something where I've ever put a lot of money on the table. And what we show in the paper is that the low active share positions that are sold, they're low conviction ideas. These are places where the manager has spent less time building up kind of information about these firms and getting attached to them relative to the high active share type ideas. And so this is kind of consistent with, say, the sunk cost or the endowment effect. It's like these are stocks I'm not really that attached to, whereas the high active share positions are ones that I know and I love. So we're going to kind of think about this sort of idea. And indeed, we're going to find that it's these kind of low active share positions that particularly underperform. So you can imagine that why might these things underperform? These are sort of neglected ideas. These are things that the manager hasn't really put fully into play, but they might actually, these kind of side ideas that the managers have, they might reflect information that's not yet incorporated into prices. And so if I'm kind of systematically kind of killing off these new, more speculative ideas too soon, this might actually be something that could explain underperformance. And indeed, it does. So what we find is that the sales of these low active share assets, they're linked with bad selling performance. And by contrast, if you take a manager and they sell one of those high active share positions, one where this is really, there's like a lot of money on the line, they are going to actually outperform these random sell counterfactuals. Now, I just want to pause and mention one last caveat here is you might think, well, then nothing you've said matters, right? Maybe it's just there are these tiny positions, and when they get rid of them, this doesn't affect their performance very much because the position weight itself was small. But importantly, the sizes of the trades are not that highly correlated with the initial position sizes. So the cost of doing something stupid with your small positions is just as high as the cost of doing something stupid with your large positions. And indeed, we showed that this bad selling is just as predictive of overall fund performance as bad buying. So it's important to kind of keep in mind the difference in terms of the units for the change in the position versus the level of the position. Okay. The last thing we're going to do in the paper is we're going to ask whether the use of heuristics, where again, we're going to use this rank effect heuristic because it's easiest to measure in our data, is this systematically associated with underperformance? And so what we're going to do is we're going to basically look at how the selling does or the buying does in periods of time when the manager is using this heuristic a lot versus periods of time when the manager is not using this heuristic. We can do this kind of sorting either within managers, so I look at their own kind of ordinal ranking of kind of whether they're doing this a lot or not, or also if I just use between manager variation and I just kind of look at absolute levels of heuristics use. What do we find? There's some other sorts in the paper I'll talk about in a second, but just to give you an idea, these orange bars capture the performance of the sell trades that occur during weeks in which the manager is really selling a lot of the extremes. And what we find is that the poor performance of these sell trades is basically concentrated exactly in the periods of time, exactly in these weeks in which the managers are using this heuristic strategy a lot. This is super costly. The sells from the periods of time with the highest quartile of heuristic use are associated with about 200 basis points of foregone returns relative to our no-skill random sell strategy. Okay, we look at some other stuff in the paper, some different potential proxies for the likely use of heuristic. One is just, is the fund having a bad quarter? So if they're really struggling, to beat their benchmark in the quarter, you can imagine this isn't so good for your kind of overall mental health, and you might be more likely to have stretched cognitive resources. So this is kind of a measure that's intended to be an empirical proxy for stress. We find that the performance is worst in periods of time when the managers are stressed. We also look at periods of time when it looks like the manager is excited about something new. So if the manager looks like they are raising cash, so we see that there's periods of time when I'm selling many individual names and I'm buying a small number of names, consistent with you have a great new idea, you want to put it in the portfolio, you want to put it to work. That's exactly when their selling performance is the worst. So they would have been much better off per our counterfactual estimates had they instead just equal kind of pro rata chopped all of their positions by the same amount or randomly selected a stock. So why don't they learn? I think that's maybe where we should end, but I'd be very curious to get Rick's take on this, given that he's been talking with these managers for several years since we finished the paper, is that, I think part of the problem is about information. The lack of attention to sales probably means it's difficult to evaluate performance. And it's a little harder to evaluate sells relative to buys. When you buy something, it stays in your portfolio. You kind of see how it does naturally as part of doing business. If you drop something from your portfolio, you have to go somewhere else to look up that information, and you need some sort of counterfactual that you compare it with. And so there's a paper that shows that misspecified models may persist because it kind of biases the way that we process information. And so there just may be, this is an environment where it may be, people may be slow to learn in the long run. We also showed that the selling underperformance kind of kicks in more than 1 month out. And so maybe in the short run, you feel really good about your sell trade, but in the long run, you're actually leaving a lot of money on the table. Okay, so just to wrap up, in this paper, we're going to document the use of heuristics in selling, but not in buying amongst experts. So again, buying and selling are not two sides of the same coin. And we're going to characterize the use of heuristics and document their consequences for returns. We're going to find that these strategies are costly. And importantly, we find that evidence that expertise in one domain, namely buying, does not necessarily transfer to a closely related domain, which is selling. So if we think about us as academics, we might be really great at coming up with ideas for new papers, but it might actually be a different skill set to think about how we optimally manage our time in terms of finishing our existing ones instead of kind of working on those exciting new ideas. And what's striking about this in the context of buying and selling for PMs is that you make these two decisions almost as frequently. There's 2.4 million buys and 2 million sells in our data set, and yet one type of decision, which is equally consequential, they do a terrible job at. So this implies scope for learning and potential returns from changes in focus. And if you don't have information that you feel like you can use when selling, it might be better to use no information at all and instead kind of follow a more mechanical strategy. So I think that's all I have to tell you today. Thank you all very much, and we really look forward to your questions and comments on the paper.
Larry, thank you very much. An informative presentation. One can definitely draw a parallel with the academic work and how we manage our projects, although we don't have as many data points on our decisions. But you do sometimes see that projects that you killed a long time ago tend to do relatively well in the counterfactual. Now, to get the ball rolling, I was wondering if perhaps Rick could tell us a bit more about kind of the practitioner perspective, of what you see in the field in terms of the reception and use of these results.
Rick, can you unmute and turn your video on?
Yeah, no, that's good. So I should say that, thank you, Larry. That was a very good run through, actually. Yeah, so I've been reminded that the microphone was off. That although we started working on this, I think Alex said 2016, we've been following the sale trades for some considerable time before, and I ran money myself for 20 years and knew this to be true. Rather depressingly, despite the success of this paper and the high profile that it's got through the Journal of Finance, both in terms of when it was published and the award, it's rather depressing to report that nothing has changed. People are still just terrible sellers. And if you took the period up to sort of lockdown, it was just as bad as it ever was. People, for all the same reasons that Larry highlighted, is that essentially all the focus is on the buying decisions and the selling decisions are merely cash raising and very rarely investment decisions. Larry was referring to, during the paper, the sort of low conviction, the small positions in the portfolio. Just might be interesting to sort of mention the opposite, which is what happens on the high conviction positions, and in particular a subset which we analyze called the high conviction long-term holdings. Now, most of you will be aware that a lot of long-only active managers in their marketing materials position themselves as quasi-private equity and managers, and that they're there for the longer term. So therefore, these high conviction long-term positions are very important to both their story and to the alpha. What we find is that the selling story is just as bad as it is in the low conviction, in the sense that they will clip their winners regularly because that's a pretty adequate and a tremendous source of capital, but also the opposite, which is referring to Larry's U-shaped curve, is that when a stock, if they've got a large long-term position which is doing really badly, they sit on it, and then they what's known as one of the heinous crimes in fund management, which is capitulation, and that they will capitulate at just the wrong time before the stock recovers. And that is a purely emotional decision where they just can't bear the pain any longer. They sell it at just the wrong time, And that is, in fund management terms, is one of the most sort of heinous crimes you can commit. But we do see it, and we see it sort of relatively frequently. The is that moving on, is that all the discussion is around equities, but we also analyze fixed income portfolios, and the selling decision is just as important. In fact, it's actually more important for fixed income managers, in the sense that if you're a credit manager or a high yield manager and you're paying 96 cents in the dollar, the best you're going to get is par. But if there's an impairment, the price would, next price is 60 cents, or if it's worse, it's fallen angel at 22 cents. So you in terms of credit and high yield in particular, the selling decisions are really, really important. And actually, whereas in equities, if your buys are just doing better than your sells, then net you can sort of say, well, okay, I'll put up with it, but it's still not optimal, but you just put up with it. In fixed income, you don't have that luxury. And because of the asymmetric nature of the return series. So, and we're finding, although the sample is much, much smaller than in equities, we're not finding massive amounts of skill in selling in fixed either. So, but maybe that's a subject for another paper at some point when we get a more fuller data set. So, in terms of the points I want to leave you with is that people are still as bad now as they were ever before, despite the success of the paper. And then when we look at the high conviction long-term positions, the heuristics just play out just as equally and just as painfully. And then the fixed income is work in progress, but at the moment we're not seeing massive amounts of skill in that area either. So hopefully that sort of brings you up to date. I don't know. It seems to have gone silent.
Can you unmute, Leonid?
Apologies. I was saying that there is a number of questions in the Q&A, so perhaps all of you could take a look, pull some of them out and answer them. And there is one I was going to ask myself. In terms of actionable advice, it seems like there is a simple thing one could do, which is a little embarrassing, but you just flip a coin and do things randomly, or do it pro rata. It's going to be better than whatever you're doing now. Perhaps you can do even better than that. But do you have a sense of the average kind of pro rata strategy being pretty much as well as you can do, or can you suggest something better than that? And then, of course, there is a question why people don't adopt it. Is it just negligence? They just sort of don't pay enough attention, or is it an agency problem? Rick's answer makes me think that part of it is an agency problem.
Larry, do you want to pick that up, or Alex?
Sure.
Or me too?
So I guess what I would say about in one sense, like pro rata is kind of that's how we implement it in our calculations, because if you randomly sell, that's kind of equivalent to just doing it equal weighted. So that's basically the counterfactual that we have considered. And we've definitely, you can do better if you, for example, exclude characteristics that predict buying, because buying looks like it's informed. And so the most simple and easiest one is, for example, to exclude the holdings that you've very recently added to the portfolio, or you've had kind of recent buy transactions, and that does a little better, not surprisingly. But yeah, I think maybe part of it is that people don't want to admit that they're not thinking about half the decisions that they make. It's certainly true that you probably in the short run are more likely to win a client by telling them about an exciting new name that you want to add to the portfolio, relative to say, oh, we're really glad that we got out of Tesla right before it tanked, because that sort of infers that maybe Tesla shouldn't have been in the portfolio to begin with. So there are some of these kinds of things, but I also just think the reporting is tricky, and that to track sells well, you actually need to think about when you sold it and what the right counterfactual is. You need to flip minus signs. And so a lot of the kind of reporting we have just naturally gives you lots of feedback on buying, whereas selling is a little bit of a different beast. And so we don't always think about, well, if I, actually just, yeah, the stock that I put in my portfolio, it went up, but actually, to get the money I needed for that, I should have done something different. It requires a different sort of counterfactual. Alex, did you look like you wanted to add something?
Yeah, I mean, it was something very similar to what you said. I've talked to some folks in industry as well, and I mean, pretty big asset managers, asking them how they handle their selling and tracking their selling. And I mean, as Larry said, like it kind of requires a sort of a different technology to track your selling, because you're basically generating counterfactuals. Rather, when you buy something, you could kind of see it every day in your portfolio and say, oh, this is doing well or this is not doing well. You see your buy price, how that stock is doing. In order to actually learn about how good your selling decisions are, you need to create a different kind of sort of platform to amend your normal sort of everyday trading decisions, where you start tracking things after they've left your portfolio, and then comparing that to other things that you that you could have sold. And so I asked people whether this sort of thing even exists. And I haven't gotten an affirmative from almost anybody where people are actually tracking how well their selling decisions are doing. So in one sense, Leonid, it is an agency issue, in the sense that if your client was saying like, look, I am going to pay attention to your selling too, like this matters for me, then they would change their strategy. But for these folks who are positively selected, they see that they're performing well, they're beating their benchmark, they're retaining their clients. There's not really a huge additional incentive for them to kind of think like, oh, I need to improve my selling, I need to change, I need to learn about this, I need to add some more technology to my process. So that's the sort of sense where I think on the extensive margin, in terms of developing the technology to learn about your selling, it is an agency issue.
Thank you. Any questions you want to pull out from the Q&A? I had a follow-up, but I want to give you a chance to answer some of the other
We've been
questions.
answering quite a bit. Let's see. So there's a question: do we have any data on whether larger, more successful fundamental managers do better at selling? Larry, correct me if I'm wrong. We did look quite a bit at heterogeneity in terms of size, in terms of success, in terms of beating the benchmark and things like that. We didn't see anything pop out at us as far as these sorts of characteristics mean that people are doing better than others. That's Larry, you can correct me if I'm wrong, but there's a bunch of tables in the paper on this.
Yeah, so I mean, so first, one thing that's very interesting is that just like the allocation of your time across your existing project is ultimately very important for publication outcomes and so on. And publications are important for lots of things that we care about, but they happen with a delay. I feel like the selling strategy looks a lot like that. And so we can actually, you can see this. So it's in some sense, I mean, what we do show is that this selling underperformance does directly translate to the fund's overall performance. So we know that that's very important for winning clients and getting assets under management, et cetera. So I think what's a little tricky is that we are seeing one pot of money. So we're kind of seeing one client's position, and they might be running a strategy that has a number of clients that are kind of similar. And so our ability to see them winning business is sort of not super easy to do in our data set. So Rick might be able to say more here because he's in touch with these folks.
Yeah,
we don't have quite the right unit of analysis to answer that specific question.
No. I mean, there's two questions, one from Adrian, another one from Dennis, both on a similar vein, which is, what do we recommend? I mean, I think the simple answer to that is that when fund managers base a selling decision based on the fundamentals, when it's an investment decision rather than a heuristic or cash raising, they tend to get that right. So the advice to both, or the response to both those questions, is to make, it's very easy for me to say rather than to do, but fundamentally this is about making sure the decision to sell a position is based on the fundamentals and not these heuristics, and then you've got a much better chance of getting it right. I mean, that's almost self-evident. It's in the sense that the opposite, the paper is all about the opposite, and certainly the reality is that when people, these are very smart individuals. Our clients are very smart individuals. They are not stupid, and there's no way that they could be described as. These are people who are at the top of their game. And when they apply those skills to the selling decisions, they by and large get them right. When they just make, off the cuff decisions, they don't get them right. And don't forget, these are very, very smart people.
And this is also a place where potentially it's useful to bring quantitative tools to the table. So we do the laziest quantitative strategy one can imagine, sort of the 1/n portfolio for selling, but you can imagine if you have kind of model benchmarks that think about what optimal weights should look like, et cetera, on kind of objective other grounds, you're likely to do much better when you if you use those to discipline your selling type transactions. But even just kind of, if you don't feel like you have a comparative advantage at generating sell signals, then just don't try, and instead just sell in a much more mechanical way. And that might be better than using your gut feeling to act as if you're informed, to behave as if you're informed when you're actually not.
So I was going to ask my follow-up question, but I'm afraid it's going to take us over the time limit. But perhaps it could be just a comment. There seems to be something interesting here in terms of lessons for market efficiency, if you take the other side, because it's not so easy to kind of underperform by selling securities. You have to, there is something about these securities they sell that is different, and it's not clear to me what it is. Is this just pure alpha in your mind, or do they all have something in common? Perhaps they have a common factor they're exposed to. That's why it looks as if you're just selling things that are going to outperform.
I mean, I guess one thing that comes to mind is that this seems somewhat reminiscent of one of the fantastic job market papers we saw this year from Daniel Graves, where it was about aggregating this information kind of at the periphery of what managers do. And in fact, that if there's a name that lots of managers add to a portfolio, and yet they typically wouldn't add that to the portfolio, when you aggregate that across all the holdings, that's actually very, very informative. And likewise, if a bunch of managers who should hold that sort of name but don't, that's also informative. And it just feels like this is kind of in a similar place where you have information, but the way in which you use the information at your disposal for this decision is different from how you would use it to make a good buying decision. And somehow we're not doing that translation well. And maybe it's because even in the short run, the selling trades look like they're okay, right? So for a few weeks, the sell trade looks like it does well. But then over the longer term, you end up having sold a stock that will subsequently do extremely well. And that's a very costly move. So it seems like it's those types of positions. It's like, this is an interesting idea. I've put it in my portfolio. It might not even be a typical sort of stock for me that I put in the portfolio. That's the one that I abandon when it has a bad quarter. And that might have actually been the idiosyncratic different idea that would give new information. And so that's kind of how we're thinking about it. It doesn't look like people trade to adjust their factor exposures. So in that sense, it really seems like these folks are in the business of trying to predict cash flows rather than kind of trade on systematic factors. But yeah, that's I feel like Daniel's paper is very much consistent with those signals that might be weak at the individual level, but then when you aggregate them across all the individuals, you potentially get a pretty strong signal out.
I think that's a very useful connection to offer perspective on this. So I think that we are at the end of our webinar. I want to thank Larry for presenting the paper, and of course, thank again the DFA for supporting this kind of work, and the rest of the author team for answering questions. And then the audience, thank you all for attending. Have a great summer. And with this, we wish you the best. We'll sign off.
Thank you.
Thank you. Bye-bye.
Bye.
Thank you. Bye-bye.
Bye.